The jobs report is going to be your big economic story tomorrow, right? 8:30 Eastern time, and we're getting some clues from the private sector on what we might expect with this 173,000 private sector jobs in the month of May having been added. By the way, weaker than expected. The market watcher Michael Block is with us, and the other watcher in all this, Michael, will be the Fed, I guess. But what about tomorrow? What do we expect in the headline to be after we get the number?
Yeah, there's 173 on the ADP today, right in line, really. Yeah. And tomorrow they're looking for non-farm payrolls to be up 160. Now the question is that enough? The whispers are really centered around that number. I'm not hearing a lot of outlying kind of numbers here. It's not very exciting.
Kind of ho-hum, not very, exactly right. So we were having a political discussion earlier, which I'll translate into an economic question or comment or let you talk about it. It was that this recovery, to the president's point yesterday, he's saying, oh, it's much better than when I started. It's basically his point. And you want to look at some numbers, yeah, that's true. And then Melissa Francis was making the point, and others have as well, that this has been a very weak recovery on a relative basis. So
you can make that argument. You also have to ask yourselves, how's quality of life? But let's look at the jobs first of all.
Okay.
Is plus 160 good enough? It's certainly better than plus 60.
Well, that's the point, right?
But does that number need to be 200 to justify the assumption that the data needs to be very good to justify higher rates on June 15th or in July by the Federal Reserve? Now, I'm going to make the argument that that 160 number is slowing down from this close to 200 trend we had earlier. But you can make the argument any which way. It's like a.
Well, your argument is that we're not at a place where we should be thinking about raising interest rates. We're not at that point yet.
I think we're late in a very distorted business cycle here, Connell. I mean, that's really where I come out on this. Here's my issue is we're talking about the data. This is blasphemy to say it, but I've been saying it for years, so I'm going to keep saying it here to you. The Fed is not data dependent. That's a ruse. That's bunk.
It's nonsense.
It is.
What are they dependent on?
They're dependent upon asset price volatility, and that's a global game here. I mean, we can watch the jobs tomorrow, and there'll be a reaction to it. And if you had an over 200 number on that non-farm payroll, you're going to see, okay, the Fed's going to go up. Now, is that good or bad? Flip a coin. Go ahead. We're stuck in a range here. We're going to trade the top of the range to the bottom of the range. We're going to break through either one. You get above that range, I want to sell them. You get below that range, I want to buy them. The important thing to watch, and not enough people are talking about, is what's going on early next week in China. The joint economic dialogue, where Treasury officials and other senior officials from the U.S. are going to be meeting with their Chinese counterparts. Now, there's a lot of pressure in China, and there's a lot of talk in China that they're going to be pressuring the Fed. What are you going to do? What are you going to do? What are you going to do? They want to know because it affects their currency. They say it affects their economy. They have a point here, and people think it does. It's certainly going to affect their markets, which, bringing it back full circle, is what I think the Fed cares about.
Okay, so we'll watch China next week.
That's going to be interesting.
And bunch of nonsense. So thank you, Michael. Make our life easier with that. Good to see you.
All right, take tomorrow off.
Thanks a lot for coming in. Why not? It's Friday.